Gary Wagner wraps up this week for us. He's up next. So we're used to seeing you at the start of the week. You're wrapping things up for us this week, however. Gary, always good to see you.
My pleasure is always to see you. How are you this morning, Daniela?
Fantastic, Gary, and I really have to give you kudos because you were calling for 1,400 gold, and that's how we can basically sum up this week.
Well, right now we've actually hit the first set of numbers that I was looking for, which was roughly at about 1,430. And so it wouldn't surprise me to see the market correct or retrace a little bit, and that would be under a normal scenario. But we have a wild card right now, and the wild card is Syria. And if any kind of conflict occurs there, we could see, dramatically higher prices. So even though I'm looking for a correction, I say that with a grain of salt.
Gary, and you mentioned Syria, and that's obviously the news item we're all paying attention to. We're also headed into a shorter trading week next week in observance of Labor Day on Monday. Markets in US and Canada close, but will you be paying attention to the Asian markets come Sunday? Could we see a big break happen?
We could. The talk right now is that if there is some sort of action by the United States, it might in fact take place this week. So that is something we want to keep our eyes and ears open to.
And Gary, what is your sentiment for the metals as we start a brand new month, as we head into September? We'll see traders back at their desks. We'll have talk of tapering in September. What are you expecting?
Well, I already see somewhat of a change. You've seen the recent spike that we've seen in gold, and that's reacted quite nicely. I do believe that we have traders returning into the marketplace. We had a softening in the equities markets that over the last couple of days has begun to firm back up. So I think that although next week will be a short week, September should offer us some real opportunities in investing as well as trading.
All right, Gary, let's get to your insert now. What have you brought us this week?
Well, really what I want to do is to outline the current scenario in gold, where we're at in terms of our Elliott wave count, but more importantly, I want to talk about Fibonacci retracement, because that is something that I use almost each and every day to determine different support and resistance levels. So I want to highlight to our viewers the various levels of support and resistance currently in gold.
Perfect. Let's get to it.
There can be no doubt that the most important topic that we have been covering over the last 3 or 4 episodes of Chart This is whether or not this recent rally, and the rally I speak of course, is the rally that started at 1181, whether or not that is indicating a end of the long correction that we have been weathering ourselves through, or if it's simply a spike up before further prices down. And my sense right now is that in terms of technical evidence, we absolutely have the evidence mounting towards the fact that we've now entered a major fifth wave, and currently, in terms of where we are within that fifth wave, is just at the beginning of it, and we're in what's called an intermediate one. Intermediate one, of course, will be followed by a corrective wave 2, intermediate 3, a corrective wave 4, and then a final concluding impulse wave, which would be wave 5. An impulse wave for a major fifth would actually need to take out the price high of our major third. And the interesting thing, of course, is that the price high of our major third is the record top at 1920. Now, also realize that when I'm talking about the actual time that it will take for a major fifth to unfold, you're not talking about any kind of a short period of time. Take a look at our major third. That really started at the end of 2008 and concluded towards the end of 2011. Our major fourth, which was where we went from our top at 1920 plus to this historical low of 1191. 1181 is our low right here. But when we consider the timeline that took, you're looking towards the end of 2011 to about the middle of 2013. So we're not talking about a short time period whatsoever. But the key is that if in fact we have ended our major fourth wave, which was this long corrective wave, then we are in a series of impulse waves. And of course, there will be peaks and valleys. I currently believe that we might be close to the first peak here because we did hit our numbers. We'll talk about that in a second. But my sense is that we are going to see a historical price rise in gold. Now, although we're going to see historical price rises in the market, and I do believe in gold, we have seen it break through the $1,400 ceiling, I do believe that we currently have a little bit of resistance in this area, and it wouldn't really surprise me if the market backed off a little bit. Let's consider this. When we look at the way the market has traded, it hit this record low at 1181 back at the end of June. And since that point, we have seen the market ascend or rally, but it's rallied really in stair steps. And this, of course, and we've talked about the Russian dolls, but this, of course, is a sub count. It is the minor count, but this is the sub count behind the minor count. Our minor count is 1, 2, and I believe that we have, in essence, probably concluded wave 3. We'll have to see. And the reason that I feel that that's likely or possible is because of the following. We might simply be weathering or looking at a small little blip or correction in the marketplace. However, the marketplace, when we did an analysis of a Fibonacci extension, and what we did is we extended wave 1 to the beginning of wave 3, we came out with the following information, and that is that a wave 1 extension of 100% would take you to around 1426. That's right here. And we had an intraday high, I believe, of about 1435. So we did hit our numbers. We did hit our mark. And then following that, you can see this is a shorter term chart, a 480-minute chart. But as you can see, we've had these series of red candles. Now, this is a standard candlestick chart. We'll go ahead and convert that to the Japanese average, and you'll see that it even is more apparent that we might be entering some sort of a short corrective period. Now, as you can see, all I've done is converted our 480-minute chart into a Japanese average chart. When we do that, you can see, especially up near the top where we ran into resistance, this is that 100% extension. You can see that on the Japanese average candles, the large size shows you that the trend is still intact, but we get this pivotal candle right here. I call it a doji candle. Doji is simply where the open and close are either identical or very, very close. And the dojis are really called that in standard candlesticks, but you do see them in these average charts. Now we've gone to red candles over the last couple of periods, and that means that it is opening and trading below the midpoint of the prior candle. And as you can see, we do have that classic, call it pivotal V, that is forming right now in the marketplace itself. And as I said, I do believe that it wouldn't surprise me if we see this market begin to correct. Now, if it does correct, what are we looking at? Well, what we would be looking at is something like this. We would probably go into a minor wave 4. This is wave 3. So what we had is wave 1, wave 2, wave 3, wave 4, and then we would have wave 5. All of that together would be our intermediate 1. Now, before we look at or attempt to plot where we think wave 5 might go, we really want to see where we think, if we do get any kind of correction, that might end up. And to do that, really what we're going to do is a simple Fibonacci retracement. Now, as you can see, I have added one Fibonacci retracement. And the retracement we're looking at is really this wave 3. And what we're saying is, if in fact this is the top here and the market corrects, wave 4 is a 23% retracement or a 38% retracement. These are the collective areas we might see the market retrace to. 23 would take you to 1389. And if it went as a 38% retracement of wave 3, it could take it as low as 1367, still be bullish, and then go into a impulse wave number 5 following that correction. Of course, another possibility in how this unfolds, this wave 3, what we could be looking at is we have 1, 2, 3, 4. I am looking at this as 5. We could get a 6 and a 7 count and have an extended wave 3, because one of the things that we looked at on our extensions were if the market were to go past a 100% extension of wave 1. I believe that we are really going to see some exciting times in the markets in the next couple of weeks. However it unfolds, I believe that we are in for most interesting times starting in September as this month comes to a close. I do want to thank you for your continued support of the Chart This series. And as you know, last week we began a series called Chart This After the Show. It contains my most current analysis that I have within the market. To be able to view the Chart This After the Show, simply go to our website, thegoldforecast.com. Scroll down to the bottom of the screen and you'll see this copyright right here. Go ahead and click that, and that will take you to the Kitco bonus content page and allow you to view the Chart This After the Show. Again, this has been Gary Wagner with Fibonacci retracement and Elliott wave as it pertains to the gold market.
Gary, thanks so much for that. We'll see you next week.
My pleasure as always.
And thanks for watching this week's edition of Chart This. We'll be back next week. In the meantime, you can email us at newsfeedback@kitco.com or follow me on Twitter at Daniela Cambone. Thanks for watching.